When I started this channel and began sharing my investment journey, I was convinced I would follow a dividend investing strategy. With dividend investing, I knew I'd be able to generate passive income and start the powerful effects of compound interest at an early age. But I recently decided to quit dividend investing entirely. So in this video, I wanted to give you a little update on my personal investing strategy and why I decided to quit dividend investing. I'm not going to knock dividend investing in this video because it's definitely a valid strategy and one that I still see a lot of value in. Instead, I want to talk about how I learned that this strategy wouldn't work for me. Then I'll share my new and considerably more aggressive investing strategy, which I expect to rectify all of the problems I had with dividend investing. Last, we'll wrap up with my new perspective on dividend investing to consider when dividend investing is actually an appropriate strategy to go with. This whole experience was important for me to have as a new investor, so I'm excited to share my thoughts for anyone who might be considering dividend investing or any other strategy. Let's get started. So as I said, when I started investing and making videos on this channel, I was really into the dividend investing strategy. In fact, most of my early videos covered dividend strategies and high yield investments, and I still feel really good about the research I put into each of these subjects. But when it came down to it, I think my interest in the dividend investing strategy was a little short-sighted. There were two main things I wanted to achieve with the strategy, and those were passive income and compound interest. And again, this isn't to knock dividend investing, because the dividend strategy definitely fulfills these goals. The problem was that the dividend investing strategy didn't really align with my more immediate financial goals and financial situation. Specifically, I realized that I didn't actually need passive income from my investments just yet, and it would be more beneficial to focus on total returns and portfolio growth instead of returns through dividends. We'll dig deeper into both of these concerns. The first reason I decided to quit dividend investing was that I realized I don't need passive income from my investments right now. And don't get me wrong, I love passive income. That's why I created this channel, run an Amazon affiliate website, and own some cryptocurrency mining hardware. But in the context of investing, I realized that focusing on this objective would actually hold me back. To give you some more context, I often think about how much money I would need to generate passively in order to completely stop working, which is a dream I'm sure everyone can relate to. The reality is, although I could probably live off of $25,000 or $30,000, I would want to see at least $40,000 coming in every year before I was confident with retiring. With all the research I've done on yield-oriented investments, I think I could easily build a portfolio that yields at least 5% annually, which means I would need about $800,000 to reach a level of passive income that I would feel comfortable living off of. However, that also means that anything less than $800,000 is not enough for me to fully live off of. Since I won't be comfortable living off of my investments until I get to that $800,000 milestone, I know I won't be quitting my job or making any drastic lifestyle changes before I get there. And if I'm not quitting my job, I really don't have an excuse to take up my dividend income and spend it, because I live comfortably at my current income level. Since this is the case, it makes more sense to continue funneling every cent of dividend income back into my portfolio to fuel compound interest and hit that $800,000 goal as fast as I can. But this is where I had to take a step back and ask myself why I was focusing on dividends in the first place. Because if I have no intentions of actually spending them, they're a pretty useless form of passive income. And through this thought process, I realized that passive dividend income from my investments isn't important to me right now at all. In reality, my goal is to hit that $800,000 mark as soon as possible so I can begin living off of my investments. This means that until I get there, it doesn't matter whether my investment returns come from dividends or from capital gains, which is what led me to the second reason I quit dividend investing. At this point, I had to take a look at dividend investing and determine if it was the best strategy for maximum returns. As I thought more about this idea, all of the cons of dividend investing popped back into my head, and ultimately, I had to realize that total returns are often superior to dividend returns. The first reason for this is that you're paying taxes on every dividend you receive. You do still get the magical effects of compound interest over time, but taxes will certainly slow it down a bit. Second, by focusing on dividend-paying stocks, you're missing out on the high-growth companies that don't pay dividends. Or if you focus on the high-yield stocks like I did, you're also missing out on the lower dividend payers like Apple, which is one example of a low-yielding stock with great returns in recent years. And in my experience, the more you focus on yield, the bigger this disparity becomes. I was getting really into things like closed-end funds, business development companies, and individual stocks like AT&T. Although they do offer substantial dividend yields, many of these investments struggle to deliver any meaningful capital gains over long-term periods. So when you compare dividend returns from these assets, which might be around 8% before taxes on the high end, you're lagging behind the returns of the market as a whole, and substantially behind some of the individual stocks that have been delivering annual returns of 15 to 20% or higher. And after this realization, it became apparent that I had been holding myself back by focusing on a dividend investing strategy. Without the need for passive income, my best option is actually to invest in the stocks and funds that will deliver the highest total returns. Once I get to $800,000 or whatever my goal ends up being, I can adjust my portfolio to passive income as needed. And this meant I needed a new investment strategy, which could be best described as aggressive growth investing. Essentially, I am now investing for the highest possible returns, which will typically exclude dividend stocks and involve some riskier investment choices. Currently, there are 3 big components to my growth investing strategy, and these include SPAC stocks, stock options, and thematic investing. SPAC stocks are the most recent discovery for me, and one that I've been putting a lot of research into lately. SPAC is short for Special Purpose Acquisition Company, and they're a bit unusual because they start off as what can be called a shell company. You invest into a SPAC for about $10 a share. Then they take that capital and acquire an active private business, eventually making you an investor in whatever business they acquire. SPACs have brought some big names to the stock market in recent months, including DraftKings, Opendoor, and Nikola. When a SPAC acquires a particularly attractive business, the shares can soar far higher than $10, netting investors some large returns in a pretty short time frame. I've covered a handful of these on my channel recently, and these very stocks are the ones responsible for a lot of my recent returns. However, SPACs do come with their own set of risks, and many people are even claiming we're in a SPAC bubble. I addressed these risks and the idea of a SPAC bubble in a recent video, and while I do think these risks are important to consider, I think there is plenty of upside left in SPAC stocks in the near term. For this reason, SPACs are going to be a big part of my strategy moving forward, especially now that I have a better grasp on researching them and identifying their most important qualities. Next is call options, which makes up the majority of my investing strategy these days. It's actually pretty rare that I buy actual shares now, because call options can magnify your returns so much more. I won't get too deep into the details here because this topic probably deserves its own video, but I'll give you the basics. With a call option, you pay a small amount of money, known as a premium, to secure the right to buy shares of a stock in the future. In doing this, you lock in your ability to purchase the stock at a specific price. There are a lot of ways to play call options, but I do it with a variation of the LEAP strategy by buying long-term in-the-money call options. By long-term, I mean that I buy call options that expire as far in the future as possible. This gives me the longest possible time frame for the stock price to increase and earn a return. This reduces my risk in the investment and maximizes my probability of success for the stocks I'm bullish on. By in the money, I mean that I'm buying call options that give me the right to buy the stock at a lower price than what it's currently trading for. And the reason I do this is because in the money call options have what are called intrinsic value, which further reduces my risk in the investment. I'll explain all this with an example. Last month, I bought a call option on STPK, which expires in December, the farthest date available at the time. Again, this gave me nearly 11 months for the stock price to increase, making it less risky than picking a call option only 1 or 2 months out. At the time, the stock was trading for about $25. I paid a $12 premium to secure shares at a $15 price. This is considered in the money because the shares were trading at $25 and I could purchase them at just $15 with the ownership of this call option. So at this point, I've invested $1,200 for the option to purchase 100 shares of STPK in the future at just $15 each. Since the difference in my potential purchase price of $15 and the current share price of $25 is $10, most of my call option is made up of intrinsic value. If the stock didn't move at all, my call option would still be worth at least $1,000 because that would be the difference between the current share price and my potential purchase price. This meant that I was really only risking about $200 because I was confident that the stock would not be trading any lower than $25 come December. So in doing this, I was able to gain exposure to the potential return of 100 shares of STPK, but I paid less than half of what it would cost to buy the shares outright, giving myself more upside potential. I also gave myself almost a year for the stock price to move upward and earn me a return, and further reduce my risk by securing an option with a lot of intrinsic value. Again, I'll likely make a video in the future dedicated to this strategy, but those are the highlights. The last component to my growth strategy is thematic investing. Thematic investing is my attempt to target investment themes that are most likely going to outperform the overall market in the near to medium term. This includes themes like renewable energy, electric vehicles, and cannabis. These are sectors that I think will have massive growth in the coming years, both domestically and internationally. So I've been researching and investing in the companies that I think are well positioned to benefit. ARK Invest is what initially inspired me to take on a thematic approach to investing, since they absolutely crushed it in 2020 with their outlook on disruptive technologies. From a growth perspective, I just think it makes the most sense to invest in the companies and trends with huge market potential, instead of the ones in their mature stages. In some cases, I've been able to combine all three of these components into one investment by placing call options on SPAC stocks in some of the themes I mentioned, like with STPK. This is something I'm excited to continue exploring moving forward, so hopefully these strategies will continue to be successful for me. Ultimately, I have nothing bad to say about dividend investing, but this experience has given me a new perspective on thinking through investing strategies in general. I want to continue becoming as educated as possible with where I'm putting my money, and as it turns out, understanding my own goals is an important part of that. I have no regrets about starting with dividend investing because it gave me a great foundation of knowledge to start investing with. But since my goal with my taxable investment account is to build my wealth as quickly as possible, this strategy just isn't what makes the most sense for me right now. Still, that's not to say I've given up on dividend investing forever, because I still see some personal applications for it. For starters, I fully intend on switching to a dividend investing and income-focused strategy when I've built enough wealth to live off of. Again, I've realized that I really don't need the passive income right now, so I'll keep working to grow my portfolio as much as possible until I'm ready to actually withdraw and spend my dividend income. Second, dividend investing continues to be a key component of my Roth IRA strategy. The tax benefits are key here, since they enable me to keep 100% of my dividends and accelerate compound interest faster than in a taxable account. Since I won't be withdrawing from this account until I'm 60, I'm happy to continue letting my dividends grow over time with more passive investments. Plus, my Roth IRA is more of my set it and forget it account, so it's not as well suited for aggressive short-term strategies. I know dividend investing is a popular strategy, so I'd love to hear your thoughts on it in the comments. Let me know whether you use a dividend investing approach and why or why not. I appreciate you sticking around for this video, and if you liked it, please consider subscribing to the channel and clicking the like button. Otherwise, I hope to see you in the next video.